We've got a rally on our hands, moments away from the start of the cash trade after Scott Bessent said on CNBC that tariffs are a melting ice cube. So that would imply we're going to get down to nothing. S&P futures right now up 3.4%. NASDAQ futures right along with them. You hear the opening bell on the New York Stock Exchange. You've got the, I believe it's the New York Fire Department, but some sort of firemen, and God, we're really thankful for all that they do. Down on the NASDAQ, you've got Wise working in support of education, which also sounds like something that we should really be thankful for. But no companies ringing the opening bells in this kind of market turmoil. Katie, what are the stocks that you're watching move at the open?
Yeah, let's get to some company shares right now. We have to start with NVIDIA leading the Magnificent Seven higher this morning after yesterday displays one of the most violent swings for U.S. stocks in years. NVIDIA shares finished about 3.5% higher yesterday, Shonali, amid the fray, and currently higher by about 6.5%.
I've got a little more green for you, Katie. Not by much, but Walgreens is up by a little over 1%. People are watching their quarterly profit topping estimates in one of its last earnings as a public company. The firm will not hold an earnings call.
Apple is snapping its biggest three-day drop since 2001. The company reportedly weighing a supply chain shift from China to Italy, India, not Italy. That would be, wow, that would be a real change. But they already make 4/5 of their phones in China. And how fast can that happen? Probably not very. Nonetheless, the shares are up 2.33%. Just the intent is enough to drive them higher. We're back with Matt Miskin, co-chief investment strategist at Manulife, John Hancock. Do you think the companies are going to be able to move their supply chains that quickly? I mean, also, does it matter if it's in China or in Vietnam or in India? Like, Trump wants it here, right?
This would take years to be able to really move those manufacturing plants back to the United States. And then also there's just not the workers, the labor force to even do it in the United States. This isn't an actual movement that's likely to be able to happen. We think the tariffs are going to be a constant moving what they want. So it is more of a barbell strategy, if you will, quality and low vol. We're trying to minimize volatility for investors here, and we're also bringing bonds into the portfolio, which have absorbed some of that volatility pretty well for us.
Yeah, you know, yesterday may be excluded, but I hear what you're saying, and I want to talk about the upcoming earnings season. It starts on Friday with the big banks, and I hear what you're saying when it comes to the U.S. is on sale right now. There's a lot of bargains to be found out there, but is that enough to overwhelm what could be a disappointing earnings season? Because you take a look at the stats from Bloomberg Intelligence for all of 2025, they now see profits rising 9.4%, which isn't bad, but that figure was 12.5% at the beginning of the year. So earnings expectations are coming down.
And they likely need to come down more. That's a great point. So
and people are lowering multiples, right?
So and this is unfortunately the game that happens with economic slowdowns. You get the multiple contraction, which is sentiment driven, and then you get the earnings revisions. Analysts have not yet woken up to this new potential regime, and they have not revised down the earnings. So it is likely that comes down from high single digits. We think it's going to be low single digits. It might even be flat this year. So that is still coming, but it's all relative. So what earnings are going to hold up the best this year? That's the work you got to do within the equity market. And to us, tech, even though it has sold off, we think is going to hold up better because, again, the margins, the moats, all that good stuff. And then those defensive sectors of what people need versus what they want. And then, you know who doesn't care about earnings? The bond market. Well, the corporate bond market does. But the high quality stuff, they don't mind if it's weaker growth. And we actually are calling for disinflation this year. We think the biggest miss with basically analyzing these tariffs and everything else going on is the thought that inflation is going to accelerate. We actually think it's going to decelerate over the course of the year. That's going to be beneficial to bonds. Maybe the Fed cuts a little more than expected.
I was just going to say, to underline your expectations, or maybe better put, your hope for the Fed this year, how many cuts do you see, and where does the 10-year end 2025?
So our fair value estimate on the 10-year is about 390, so it's still 30 basis points lower, but that's without a recession. If we're in a recession by the end of the year, we think actually the 10-year could have a 2 handle on it.
Ooh.
And that the Fed's going to be cutting more than the 4 times that's priced in. We think the 4 times is basically just, hey, inflation is slowing. We're going to kind of do this more methodically. But the bond market has not priced in a recession by any means, even though the equity market Kind of is. So there's still a lot of bond returns left. The Fed hasn't given you the green light yet on the bond market. They're saying red light, hey, we're not done here yet. We're still concerned with inflation, but that could leave them behind the curve if the wealth effect does diminish here, if the economy does slow more than expected. And that's good. Bonds and stocks are not acting the same. The correlations are dropping, which is great for multi-asset investors like ourselves.
Let's finish on that point, because if we do end up in a scenario where 10-year yields are trading with a 2 handle, what is the equity market doing? Because that sounds like a recession to me.
Yeah, it's still likely lower from here. So if you basically look at drawdowns, if it's a non-recession drawdown, expect kind of mid 20% type drawdown. We're already at, what, 17? We're most of the way there for non-recession. In recession, it's more like 37%. So we've got more. So for us right now, you're getting a lot of price discounts in a non-recession environment, but it isn't pricing in a recession. We are still leaning into bonds relative to stocks, getting some nice income while we wait, mitigating the volatility, and looking for some equity opportunities here as they sell off.
All right, Matt, it's always great to speak with you. Nice to get a good chunk of time with you this morning. That is Manulife, John Hancock's Matt Miskin. Meanwhile, let's look under the hood because we have plenty of movers on our radar. I want to start with Levi Strauss, up 5%. Shares were up as much as 16% at the open. That would have been its most intraday in a year. That's after they reported earnings and seemingly shrugged off the impact from tariffs. Specifically, they said that tariffs will have a minimal impact on their margins in the current quarter. The CEO also said that the company would raise prices surgically, but you can see, Shonali, some of those gains coming back right now.
I've got another tariff story for you. I'm watching Micron because it's rising after a report that it is imposing a surcharge on some products sold in the U.S. to compensate for Trump's tariffs. You're seeing the stock up almost 5%, not the biggest gainer in the Philadelphia Semiconductor Index, but close to it. And you are seeing others, like Bloomberg Intelligence, react that this could dent demand, but clearly this tariff reaction, the early tariff reaction, is not hurting the rebound, at least on the onset. Now we're going to get a look at some other stocks on the move this morning. We are going to bring in Bloomberg's Sunita Sekova for that.
Yeah, we've been talking about deep buying. We've been talking about deals. Goldman Sachs just upgraded Eli Lilly. They saw a compelling entry point. The stock is up about 4% at the open. Of course, it had a very rough day on Monday. The stock fell after the Trump administration spiked a plan to pay for obesity drugs for Medicare patients. We're seeing a lot of optimism for the stock more broadly. We have 29 buy ratings according to Bloomberg. The stock dropped 13% over the big sell-off in the last 3 days, but clearly the buyers are stepping in. There is some good news and upgrades from Goldman Sachs. One interesting stat is they see the value tripling from 28 to 95 billion by 2030. So a lot of optimism for Eli Lilly from Goldman for sure.
All right, thanks very much for joining us, Denitsa Sekova there. Coming up, Stellantis offers to help its suppliers shoulder tariff costs. We'll look at autos next because there's a lot more than that going on. This is Open Interest.
Welcome back to Open Interest. A quick check on stocks. You have green across the board. Not quite session highs, but pretty close. NVIDIA shares up nearly 6% right now. That's why you see the NASDAQ 100 out in charge. We'll keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Morgan Stanley is upgrading Charles Schwab in its hunt for more defensive exposures. The firm is also upgrading CME and cutting Robinhood. Next up, education technology company Chegg getting downgraded to a sell over at JP Morgan. The firm says that economic weakness will drive students to prioritize making money at secondary jobs ahead of education, which is pretty grim. And finally, GM getting downgraded to a sell over at Bernstein because of the tariff impact. The analyst says that the outlook for GM is, quote, clearly unfavorable. Matt Miller.
Well, let's stay on cars. The maker of Jeeps, Stellantis, is offering to help suppliers shoulder the cost of tariffs. The automaker has outlined a program which its suppliers can apply for as the initial shock of levies on autos and the coming duties on parts rock the industry. For more, we're joined by Bloomberg's Detroit bureau chief, David Welch. And David, so much going on with Stellantis. Their production in Italy has absolutely tanked to levels we haven't seen since the 1950s. And it looks like they're shopping Maserati and Alfa Romeo. At least they've tapped a consultant to look at those units. So what do we know?
Well, look, the company's had a lot of problems. Its cash cow is really the U.S. business, and that business has stumbled. The European business, for any company, but especially Stellantis, is pretty tough. The margins have always been pretty poor, and they've got some of they're strongest in some of the weaker markets with their mainstream brands. So it's not a surprise that they want to shop these luxury brands in the same way that Ferrari was IPO'd a long time ago. They're not going to get that kind of money like they did with Ferrari, but if they shop some of these brands, they'll get some cash flow, and it'll also help the company focus. I mean, if you look at Stellantis, it has a bigger family of brands right now than pre-bankruptcy General Motors did when GM was trying to manage stuff like Saab and the old Hummer brand and Pontiac and all this other stuff. It's just a huge burden to do design, product development, marketing for this big house that they've got. So if they can get a little bit of cash and narrow their focus, probably a good thing for them if they can make it happen.
David, do they keep Chrysler and Dodge? Because, yes, those are two brands that they own, but they don't really make any products anymore.
Yeah, you do have minivans, which is still a decent business for them. Maybe the sports sedans, but do you need two whole brands to do that? That's really tough to see. I mean, what they could do with some of these vehicles that they need is just kind of like they did with Ram. It used to be the Dodge Ram. Now it's just a Ram. They could still sell it at the same dealerships that sell Jeeps and everything else. And by the way, most of their brands in the U.S. are all under one dealer roof if you go to shop them. So they could have a minivan, and if they wanted to keep one of those rear drive sedans for fleet business and for sports cars, they could just brand it without an overarching brand and then have them sold at the same dealerships who are buying the rest of their line.
David, I've looked at some of the things that have happened since, for example, Porsche spun off. Didn't go that well. I mean, Matt makes a point that it worked for Volkswagen. So you have mixed success in spinning off brands. But in my mind, I guess I'm skeptical because the reason they all came together in the first place was to share the benefits of scale. So are those benefits deeply lost if you see some sort of siphoning and pushing things away from each other in terms of supply chain?
One of the issues, though, with these sports car brands and some luxury brands is that they don't share enough with the mainstream companies' brands. General Motors makes it work with Cadillac because it's they have two sedans, but it's largely SUVs, and so they're sharing a lot of SUV parts. When you're talking about sports cars, in luxury sedans, it's a different animal than most of the volume that mainstream brands are getting, which is all in small, medium-sized crossover SUVs. So, are they sharing enough to make that work? I don't know if they're getting enough out of the parts bin for them, and maybe a company like Volkswagen actually would be better because they've got a bunch of luxury brands that have a lot of hardware that could be usable by these brands. I'm not saying Volkswagen's interested in this. I'm just saying they're the kind of company that has made sense because they've already got luxury in their line.
All right, David, great to speak with you as always. That is Bloomberg's David Welch. And we also want to take a look at coal stocks right now, moving higher after our Press Secretary Carolyn Levitt tweeted or posted that today at 3 p.m., President Trump will sign an executive order to reinvigorate, quote, affordable, reliable, and clean coal. Peabody leading the charge right here, up about 10%, was higher by as much as 18% in the minutes after those headlines dropped. Core Natural Resources and Warrior Met Coal also moving higher on the day. Now, coming up, investors are bracing for sour corporate earnings as the impact of tariffs looms over Wall Street. We'll take a look next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. We're looking at a big rebound. You're going to hear the phrase turnaround Tuesday a lot, like you do every time there's green on the screen Tuesday and Monday was red. But here it's really serious. 3% on the S&P 500, and we were only down, what, 0.3% yesterday? The NASDAQ 100 up 3% as well, as tech stocks really lead the way. Even small caps are getting some love today, so some people really willing to place some bets. In terms of the individual stocks, Nvidia is huge, a gain of almost 7%, and a $2 trillion stock. That means a lot. Tesla up 3.7%. This is a fascinating story that we're going to dig into because Elon Musk has said he thinks tariffs should be zero, at least between the U.S. and Europe, and that seems to go against really the morals of his best friend in the White House. Apple up almost 3% after a 19% decline in 2 days. We gave you the coal story just a moment ago, and then Walgreens Boots Alliance up only 1%, but after earnings kicking off that season.
Speaking of earnings, Wall Street is bracing as more corporate earnings roll out starting later this week. Now, investors are worried about the impact of tariffs on operating margins and earnings outlooks. Here with more, Phil Donahadrick of Bloomberg News. And you're looking at, for example, BI Analysis, saying that the EPS growth in this first quarter is looking pretty low. It's looking at rising at the slowest pace since the third quarter of 2023. How are investors reacting to these new expectations?
I
think the key here is the word uncertainty, obviously, because a lot of companies that are trying to look ahead over the next year, how do they make decisions in this environment? And hence you have analysts cutting down first quarter estimates for what they're expecting for S&P 500 earnings. But we also have a model from Bloomberg Intelligence saying that even with the ratcheting down that we've seen thus far, the estimates suggest that maybe they're a little bit too optimistic at this point, and that we could see further downgrades as companies start coming out with.
And we just heard
earnings.
that from Matt Miskin, actually, that analysts are still too optimistic when it comes to what this earnings season holds. And it feels similar to the jobs report in that it's not necessarily about the numbers we get, because they're kind of stale in the context of, okay, the world has changed and theoretically will change when we implement tariffs tomorrow. How do companies even model what's going to happen? Are we expecting to see companies just pull guidance altogether?
That's a really good question, and it's a big possibility, and it really makes me think back to the early COVID months when a lot of companies, they were so uncertain about what the future was going to be holding. They weren't sure about supply chains and consumer confidence and all of these different things that they have to input in terms of looking ahead into the future. And so we have Dan Ives, for example, arguably the best known tech analyst, saying in a note earlier this week that with the current situation, he does not expect tech companies, most tech companies, to be giving any guidance on their first quarter calls. So we'll wait and see what happens. We're going to hear from companies pretty soon, but that's a stark reminder of the environment that everybody's dealing with.
Doesn't help to leave people in the dark. Lori Calvasina yesterday was furious that these companies aren't doing more to guide investors. And what we didn't get yesterday, guys, from Jamie Dimon was his weather forecast. We don't actually know how bad he sees things coming.
Yeah, although we have heard, even in the last quarter's calls, we heard some CEOs speaking out against tariffs. You're starting to see a little bit more of that in corporate America. The Restoration Hardware call was hilarious,
oh, man.
right?
It's instant classic.
Yes. So do you expect some of these CEOs to really come out hard against tariffs?
Like you said, more are coming out. I think it's notable that somebody like Bill Ackman came out over the weekend saying something like, this could be like a nuclear winter when it comes to the outlook, when it comes to the economy.
That's a weather forecast.
That's a really dire weather forecast. But those are really stark words, and that's somebody who had backed the administration, backed the president all along on a number of different policies. And so just to hear more people coming out and talking about what they're feeling, what they're seeing, what they're expecting,
right.
It's possible we start to see more and more as this drags on.
Well, just in the last minute we have with you, take us into how investors are positioning amid all this uncertainty. When you take a look at ETF flows, for example, I know that there's been a lot of two-way traffic.
So much two-way traffic, yes. It's a little bit difficult to actually look at the overall picture at this point because there is quite substantial dip buying happening with certain products. So for instance, a levered NASDAQ 100 ETF saw a huge inflow yesterday, which obviously it can look great in the short term when you get a bounce. But overall, I think there is still a bit of a sense of we have to wait and see what further information we get. Obviously, we're getting headlines about different phone calls that the administration is holding with different countries around the world, investors reacting to those types of things, but it's still a bit too early to form an overall picture.
Right, you mentioned that big flow. TQQQ, which is 3 times levered, the NASDAQ 100 took in $1.5 billion yesterday, currently up about 11%, Matt Miller.
All right, we're looking at stocks really jumping up here now, 3.5%, the gains on the S&P 500 as we get just about a half hour into the session. Coming up the next hour, Karen Pei of Franklin Templeton joins us. Plus, we get to hear from Snap-on's Nick Pinchuk, as well as Leland Miller of the China Beige Book. This is Open Interest. 30 minutes into the trading day, and we have a rally on our hands. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld.
And coming up in the green, stocks rebounding from a 3-day sell-off as countries rush to the tariff negotiating table.
But a fight to the end is what China is pledging to retaliate as President Trump threatens to slap Beijing with an additional 50% import tax.
And fresh off his trip to Asia, we'll hear from Snap-on CEO Nick Pinchuk as Trump's tariff strategy sparks uncertainty and criticism from manufacturers. All that and more coming up, but let's check on these markets. The S&P 500 fresh off its session highs, now up about 3.6% on hefty volume. You take a look at what is actually moving right now. You only have 17 stocks in the red right now. This is a big, broad bounce back from really the carnage that we've seen over the last 3 days or so, Matt Miller. We'll have to see if it can sustain itself.
Yeah, absolutely. And let's talk a little bit about that carnage and the results. Joining us now is Karen Pei, Fiduciary Trust International Head of Portfolio Management and Equities. And Karen, I want to talk first about, you know, I think we were conditioned in the past years to put a much heavier balance of stocks into our portfolios. And they're also a much heavier mix of big tech, big cap tech stocks. So what did that, 10% loss on Thursday and Friday, or 10% plus loss, mean for most people's portfolios?
Well, certainly portfolios are down on a year-to-date basis and have retraced a lot of the gains actually from last year. In fact, the market, as you know, has retraced the gains from 2024. So portfolios are definitely suffering in this most recent decline. The swiftness of the sell-off is quite incredible. I think that with the sell-off in the last couple of days, I do think for long-term investors, we've gotten valuations to the point where they're attractive as they've been in a long time. And I think that the market actually here, we were talking about this yesterday at our meetings, that there's some great opportunities that are coming up based on the rapid sell-off that we're seeing in the markets here. So, we saw VIX levels go up to 60. Sentiment was really negative. So it's not surprising to see this kind of bounce in the market.
Yeah, it's interesting, of course, to see that action in the VIX. There was actually a really interesting note from Bespoke, who said that on the VIX, so it closed at just below 47. Intraday briefly traded above 60, to your point. It's only done that on 52 other trading days since 1990. So some really historic moves that we're seeing in volatility. But there's a lot of talk about indiscriminate selling. You say that there are opportunities to be found, but how do you separate out what is being disproportionately punished right now versus what actually should be re-rating?
Yes, I think that is actually the most difficult part, because there is still a great deal of uncertainty out there. I think what's interesting is that this market sell-off and the conditions here are pretty much self-inflicted, right? So we have seen the markets correct and sell off to the point that's very similar to what happened during COVID. But what happened during COVID was clearly an unknown. There was a health crisis, and whereas today some of these policies and the tariffs that are imposed can be quickly reversed if someone chooses to do so, right? And I think that there are definitely negotiations going on, as you guys were talking about. Countries are coming to the table to try to make a deal. So it's very difficult to try to gauge how much is priced in. But I do think that we've seen some stocks that have sold off 50% from the highs. We've seen stocks sell off about 30%. I feel like for the ones where we have confidence and conviction in terms of the CapEx spending, in terms of the growth for the future, those stocks are probably where investors want to gravitate towards at this time.
I also want to know what you're going to do at this point with bonds, because the 10-year, we've been talking about it. I was thinking Jim Bianco is calling this is a tell your grandkids kind of moment in the bond market when you see a 10-year spike by almost 19 basis points yesterday and another 7 today. We're at 425 on the 10-year. We were sitting here with John Hancock's Matt Miskin, who said that you could see in the event of a recession, yields drop significantly. Was it two-handle, Katie, on the 10-year?
You did say a two-handle.
I almost have to say it twice. It's so low if you see a recession. So what do you do? I mean, do you pile into bonds, or is it too risky?
Yeah, so we think it's really important to have a diversified portfolio at this point. So bonds offer some protection in case, right? It's really, as we mentioned, it's really unpredictable. So bonds can offer a buffer in portfolios. We, in our strategy, we've been overweight fixed income for some time. We felt that valuations on equities were very expensive at the beginning of the year. Valuations have corrected on equities. And we also think that at this juncture, there is an argument to actually have a fully diversified portfolio, including bonds, including equities. And within equities, you also want to have a diversified portfolio. We've been coming into this year, we favor, for example, defensive sectors. But now, they've outperformed so much. And you've seen cyclical stocks actually get really beaten up here. And so from that standpoint, I really think a barbell strategy in terms of asset allocation, in terms of a balanced portfolio, and even within equities, barbell high growth and barbell value dividend stocks. I will also be neutral cyclicals versus non-cyclicals.
What about international? I mean, do you want to invest in a place where fiscal policy is better telegraphed and the rule of law is more consistent?
So I think that that's a good question. I mean, we've seen international markets rally year to date and have outperformed the U.S. markets. I think we're probably coming to the sort of end of that in the sense that, they've rallied on a valuation recovery. But, the international markets aren't necessarily better off from an economic growth standpoint. And so, at this point, I wouldn't necessarily be adding more money to the international markets. We keep our exposure there for diversification, but there does appear actually to be, I think, potentially a little bit more of a shift back to U.S. equities.
All right, Karen, got to leave it there. Great to see you, especially in person. That is Karen Pei of Fiduciary Trust. Meanwhile, the S&P 500 sitting near session highs, up about 3.8%. Let's get a look at what's moving underneath the surface with Bloomberg's Denitsa Seikova and those health insurers certainly helping this index.
Yes, Katie, we're seeing some of the big winners there. We're seeing gains of, they were as much as 11% in the earlier trading, but if we look at United Healthcare, if you look at CVS, we're seeing very strong 7-8% jump today. Of course, this is coming on the back of news that the U.S. government will pay private Medicare Advantage plans more next year than expected. And actually what we're hearing, this is way above expectations. We're talking about a 5% average rate, which is more than double what the government suggested in January. If we have to put a stat on this, this will be $25 billion more being paid next year from the government to Medicare Advantage. Clearly, this is lifting the sector. Some of those names are one of the few stocks that are up on the year. Obviously, today is especially good day. And those companies have been facing a lot of scrutiny in Washington lately. So this is kind of the best days for all of those so far this year.
Let's take a look at Nike also, because, of course, since Liberation Day tariffs were announced, it's been hard hit. It bounced back. It's bouncing back a little more today.
Yeah, for sure. Nike is kind of a good proxy of that buy the dip sentiment. It was actually up about 5% earlier today. We see still a gain of 4%. What we've seen there is a lot of the relief came after the negotiations with Vietnam that the president was saying that they're doing well. Obviously, there is some expectation about Cambodia, Indonesia as well. Today, we have more positive language coming from the White House about the melting cube, and obviously that is helping, and Nike is a good proxy of that trade. That said, when it comes to earnings, we've seen some worrisome signs there, but still we clearly see that investors are happy to ignore that if there are positive developments on the macro front.
What's the story with CME? They got an upgrade?
Yeah, I love that. They got an upgrade from Morgan Stanley, CME, Cboe. So we're seeing all those big exchanges some that will benefit from market volatility. And clearly today is a buy the dip day, but we saw the VIX, we saw what's been happening in the last few weeks. So while they're upgrading CBOE, while they're upgrading CME, they're actually putting equal weight on Robinhood. So there is an interesting arbitrage where Morgan Stanley is positive and is finding defensive positioning in those big names that work with institutions and bigger investors, but they're growing more pessimistic on Robinhood and all those brokerages that obviously work with retail. Even though we've seen some dip buying, clearly companies are worried that the retail traders will get a lot of pressure in the volatility, which practically we haven't seen since 2020.
Yeah, and Robinhood shares defiant today, up about 5.7%, but so is everything else. Bloomberg's Denitsa Sekova, great roundup. Now coming up, billionaire Ken Griffin blasts President Trump's tariff policy. We'll bring you his comments next in our Wall Street Beat. This is Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. President Trump is rejecting a European Union proposal to drop tariffs on all bilateral trade with the U.S. They wanted to completely get rid of them, and we decided no. That means his 20% tariff on EU imports will come into force tomorrow. The EU will begin consulting with member states and industry early next week on how it plans to retaliate. Global investors are finding credible alternatives to U.S. Treasury bonds as yields on the 10-year Treasury tumbled to below 4% over the past few sessions. Comparable rates in both Europe and Japan remain higher this year, while both are still well below Treasury yields. They're at levels that make them look more attractive. That might entice investors to shift allocations to markets where the policy outlook appears more stable. And Bluecrest Capital Management, a hedge fund founded by Michael Platt, is up 20% this year as it navigates the market turmoil sparked by President Trump's tariff moves. Bluecrest solely manages the wealth of Platt and his partners. It's delivered some of the best trading profits in the world. Shonali?
And it's time now for the Wall Street Beat. We are looking at Citadel's Ken Griffin. He is calling the president's tariffs a huge policy mistake. In a quote, he spoke at an event in Miami yesterday and warned about the impact to the middle class. We're going to now bring in Bloomberg's chief hedge fund correspondent, Nishant Kumar, to talk more about this. You know, I actually had the first real interview with Ken Griffin in the wake of the election. He said that at that time that tariffs would lead to crony capitalism. Now he's calling it a huge policy mistake that will take a tax on the middle class. How widely spread are these views? What's interesting to me about Ken Griffin speaking in Florida is, of course, that is close to the other center of power in Florida, which is, of course, Mar-a-Lago. Do the people around him share this view, or is it controversial?
Well, it's increasingly becoming the consensus view, it seems, especially among the billionaire fans of Donald Trump. I mean, they are probably having their oops moment right now. Few expected him to go through this sort of a policy and engage in this sort of a Twitter or X war, you know, sending messages every morning and causing volatility in the market. So for sure, like Bill Ackman is one of them who came out and said that, you know, he did a mistake and he doesn't, I mean, the tariff will cause economic nuclear winter, in his words.
So, Nishant, when people close to the administration or close to the GOP, and I understand that Griffin is not a donor to Trump, but obviously, you know, he's given $100 million to other Republican candidates and causes. Can you say that it's that their criticisms are based on losses? For example, Ackman had a big investment in Nike, right? Or Musk, you know, obviously has big investments in China. And so Trump allies are saying, hey, they're just being critical because they're losing their own money. Is Ken Griffin losing money based on the tariff policy that went into effect on Saturday and what's going to go into effect tonight?
Well, Ken Griffin hasn't lost money. His investment firm was flat almost last week. It lost just 35 basis points. So in his case, especially, like it doesn't seem to be driven by the returns itself, but generally its view on the economy and how the tariff policy is really starting to affect the economy, the chances of a recession in U.S., and of course the stock market and asset prices melting.
And, you know, I would say we don't know the numbers actually for the first quarter for Citadel Securities, but given the volatility, what the bank's trading desks do, I'm sure will be a good barometer of how well they're doing. Nishant, I want to kind of knock down the notion that all hedge funds are failing or all family offices are failing in this environment. You are out with the headline of Michael Platt's Bluecrest just soaring. Bridgewater, at least through March, was really up double digits, close to double digits, if not more. Schoenfeld is up. Who's benefiting in this environment?
I mean, really, Michael Platt making money during episodes of volatility is not news anymore. Like, he does it all the time. He has this amazing money printing machine. I mean, look at his returns. It's annualizing at 30-40% since he returned capital to investors. The key behind his stellar performance is, of course, mountains of leverage. That's what makes a trade click, and that's why he makes so much money. But generally, if you look at multi-strat world, I mean, they have fared, considered like really well. I know zero is not a number that one celebrates when it comes to returns, but essentially, if you were flat last week, that was a remarkable achievement, and we see that across multi-strategy hedge funds. Schoenfeld even made some money. Citadel kind of flattish. Millennium minus 70 basis points. Balyasny flat. So these are some really solid numbers at the time of this market chaos.
All right, Nishant, thanks so much for joining us. Bloomberg's Nishant Kumar reporting on hedge funds out of London. Still ahead, Elon Musk calls Trump trade advisor Peter Navarro A moron says he's truly a moron as their White House feud turns ugly. We'll have details next. This is Bloomberg Open Interest. A new White House feud is spilling over into the Twitter sphere. Peter Navarro, President Trump's top trade advisor, who also apparently goes by the pseudonym Ron Vera, dismissed Elon Musk's push for zero tariffs between the U.S. and Europe, calling the Tesla CEO not even a car manufacturer, but a car assembler, reliant on parts from other countries. Musk, meanwhile, just posted on X, quote, "Navarro is truly a moron. What he says here is demonstrably false. By any definition whatsoever, Tesla is the most vertically integrated auto manufacturer in the United States of America with the highest percentage of American content. Navarro should ask the fake expert he invented, the aforementioned Ron Vera." Let's bring in Bloomberg technology co-host Ed Ludlow with details. So aside from, you know, the fake economists that Navarro cites in his research, what do we know about this feud?
Well, I think there is certainly a rift between Elon Musk and others around Donald Trump on the issue of tariffs, right? There were reports over the weekend that Musk had made a direct appeal to Trump in the hours that preceded the news of Monday and the markets of Monday to rethink the tariff stance. What's interesting, though, is like Tesla is the most insulated of the US automakers and the foreign OEMs that manufacture in the United States, right? There is data, it is in Tesla's 10Ks and the annual impact report that it publishes about the volume and locality of components that are assembled. So take Austin, for example, Austin, Texas. Tesla's VP of Finance pointed out that that the powertrain or drivetrain components, not just the assembly of the car itself, but the motor and the battery pack are all done there locally on site. And, you know, Musk himself referenced this Kelley Blue Book data that Tesla makes the most American-made cars. But that's data that's there to see. Clearly, there is some pressure, though, coming from somewhere.
Yeah, absolutely. I do want to check at Tesla shares up about 6.7%, close to a session high. I don't know if that's related to this feud that we're seeing play out on social media. But Ed, you make a good point. I mean, that there's folks within Trump's inner circle who are feuding right now. Elon Musk obviously is part of that feud. And this comes as potentially we're counting down to when his time as a special advisor to this administration comes to an end.
Yeah, I mean, the Doge position is a remit. You know, it's in the documents communicated by the White House that it has a term limit up until, I think, July 1st, right? And the White House has very recently denied a report that Musk would leave that role early. They said it was, you know, fake news. But at the same time, like, up 6% in a session, what does that mean in aggregate over a week where Tesla's been absolutely hammered? There's big concerns from the market that just by association, forget the tariff risk. Of course, there is some modeled into Tesla's share price because raw materials, and there is an element of cars exported from China to the European market. It's a global story, but the association risk is the bigger issue with this stock, right? That consumers have a strong opinion of Elon Musk by his association with what the administration's doing, and that might have more of an impact.
We have less than a minute left. Where do you see Elon Musk's objectives clashing the most with the administration's?
Well, the one that I'm waiting on, you know, people have short memories with respect in the markets, is that Musk said very publicly on a Tesla earnings call that he was going to use his position to federally regulate self-driving cars. There's a June deadline that Tesla has self-imposed to launch its robotaxi service in Texas, a soft launch. You know, that would be a major story, that suddenly federal regulations appeared for this nascent technology influenced by somebody who has a clear remit in Doge, right? Irrespective of his relationships or lack of with the wider Trump cabinet.
All right, Ed, great reporting as always. Great to have you back, too. That is Ed Ludlow, the co-host of Bloomberg Technology. Meanwhile, a quick check on markets right now. The S&P 500 up by 3.7%. That is the biggest intraday rally since November 2022. Remember, 2022 was a painful year for the S&P 500, so do with that with you will. But coming up, China pledges retaliation against Donald Trump's latest tariff threats. We'll speak with the CEO of Snap-on next. This is Bloomberg.
Cool.
Well, China says it's not backing down from a tariff war with the United States. The Chinese Ministry of Commerce said in a statement, if the U.S. insists on its own way, China will fight to the end. Tools giant Snap-on will speak to his CEO now, Nick Pinchuk. He just returned from a trip to Asia. He joins us now to get a boots-on-the-ground read on manufacturing overseas. And Nick, my understanding is that you have 5 factories in China. So what does this mean for your business?
Well, Katie, I think, we're a little different in that we tend to make in the markets where we sell. So our 5 factories in China are there principally to try to sell in the Asian market. We make in the 80% of what we sell off the trucks is in the United States. Is made right here. But in terms of what it means for the factories in China, of course, they export some to the United States. And so they may lose that volume depending on how high the tariffs are. 104%, which would be the 10 plus 10 plus 25 and the 34 and 50 more would be 100. That would be difficult to overcome. And so we'd probably adjust to that. But I think they're not shaking in their boots. They're worried about it, and they'd have to step up their efforts to focus on the Asian markets. That would be what happens. I do think, though, in Asia, that many of the companies that are, particularly in China, are operating at small margins and can't do very much about absorbing the tariffs. So they're kind of worried about it. They'll probably try to adjust for a while, but they won't be able to do anything. And I don't think the Chinese government is in a position. I think they're pretty serious about trying to resist the tariffs because I think Xi Jinping is sitting on an economic difficulty right now. He's not going to want to seem to kowtow to America. In fact, I think he said something like that last night. And so I believe we're in for a little bit of, turbulence with the China market as well.
Nick, I got to ask. I was in Austin last weekend riding a Harley Davidson Fat Bob, and I needed to change one of the foot pegs. So I pulled over quickly at Home Depot, and I bought a Husky, made in China double ratcheting wrench. It was $32, I think. I look at the same wrench on your website, and it's like $110. So already you're priced much higher than that Chinese-made stuff at Home Depot. Are you going to have to raise prices even further when these tariffs go into effect?
Actually, right now, I don't know how we can afford to sell it for that price. It's so good a wrench. It's like a bargain. But look, I don't think that in the United States, actually, wrenches are pretty much made here. We're using American steel. Now, to the extent American steel goes up, maybe we'll have to price for that. The thing about this is what's kind of interesting when you step back and look at the tariffs. Right now, we're in the fog of tariffs. I think this is Clausewitz or Robert McNamara talked about this kind of thing. There are so many variables that people have been trying to figure out how to sort their way through it. But the way forward is going to be that they are going to try, companies are going to try to resource or reshore things. We're already reshored, so we don't have too much of a problem. We're not immune to the tariff problems, but we're resistant to it. But here's the difficulty. It's going to take years. It's not so easy for that to happen. To make something like hand tools, one thing to assemble in the United States, it's another thing to make components out of steel or other difficulties in complex shapes and manufacture them. We had a competitor who tried to do this. People talk about, well, maybe technology will ease the way. We'll all have robots. We have robots all over our plants, but they have been robots and technologies that's been overlaid on know-how that's already there. We've had competitors who have tried to build tools in the United States, robotizing everything and spit up blood all over it, had to write it all off. So it's not so difficult. So you're going to see some time for this to come on.
Well, one other aspect of this that I find to be confusing at this juncture in the trade talks is you have President Trump coming out talking about his talks with South Korea this morning. You have Kevin Hassett of the National Economic Council talking about prioritizing trading partners, allies like South Korea and Japan. You have Apple talking about India as another base for making iPhones, for example. What if this isn't a matter of onshoring all manufacturing? To what extent is this just about moving manufacturing and imports away from China?
Okay, if you want to move away from China, I say good luck. Vietnam, I was in Vietnam in the war, and I've been there maybe dozens of times since. Tough. India, yike. So it's not so easy to do that. You might as well move it to the United States. See, the thing about the United States, the advantage the Chinese have is not only lower labor, they have lower regulations and they have an availability of the workforce. We need that in the U.S. One of the things I will say, and the National Association of Manufacturers will say this, we don't need the tariffs to impel onshoring. After the pandemic, when the supply chain was interrupted, there were all kinds of industrials trying to go here and say, we cannot depend on these long supply chains. The manufacturing goods are too important. We can't leave our prosperity in the hands of other countries that might interrupt them by happenstance or by intent. And so we ought to onshore. But it wasn't easy to do because there wasn't enough skilled labor, and the regulation is tremendous here. The National Association of Manufacturers says that the average manufacturer pays $25,000 per year per employee on regulation costs, and small manufacturers, which is 93% of those manufacturers, pay much more per employee. Right. So those things need to be fixed more quickly. And then if you fix those, I believe people will come here because they've now been convinced we cannot depend on other countries for the manufacturing, either for our companies or our countries. The idea, one of the great things that comes out of this tariff thing is you say, well, wait a minute, it's going to take us 5 years or 3 years to put manufacturing onshore. Well, what does that mean about depending on other countries like India or Vietnam or China or other places for that? If there's a natural disaster or a conflict like, Sam Huntington, the Clash of Civilizations, we won't be able to replace that very quickly, and we'll be at a great disadvantage. And I think people know this, and therefore they're interested in onshoring. It's just we need more workers. We need to upskill the American workforce. We need to convince people that manufacturing is an American calling, not just being a place where it's dark, dumb, and dirty. It's a place where you can keep your families warm and safe and dry and have the dignity of work around creation rather than transaction or service. And you'll have a great pay and great life associated with it. And I think that's why the tariffs are kind of interesting, but they're not really needed in that situation. Right. You may want to tariff punitively or countermeasures like people like China, because Alexander Hamilton said in 1791 that that's an appropriate thing. If someone's trying to asymmetrically empower their country champions to penetrate your own markets, you have to take actions. Mm-hmm. And so China may be one of those places. But the broad tariffs are not necessary.
Right. It's a good point to end it on that, tariffs aren't going to fix the problems that come with, the labor market. When it comes to some of this workforce, it needs a messaging refresh. Nick, we got to leave it there, but have to have you back on soon. That is Nick Pinchuk of Snap-on. Meanwhile, quick check on these equity markets. The S&P 500 still hanging out near session highs, up 3.7%. It's big tech that's leading that big rebound, rather. And you can see that in the NASDAQ 100, up more than 4%. But it's not only that, bond sell-off continues all the while.
Yeah, it is a pretty incredible thing to watch. A lot of theories around exactly where that's coming from. We will get you everything as we know it. But right now, we're going to get you what we know about stocks moving under the hood this hour. Bloomberg's Isabel Lee. We were watching Walgreens get a bit of a lift. Are we still seeing it?
We're still seeing it. It's up around 1.5%. And Walgreens reported earnings that exceeded expectations. And this really marks a strong performance for a company that might be reporting one of its last earnings as a public company. Recall that Walgreens was acquired by Sycamore Partners for around $10 billion, and it will push through by the end of 2025. So the company reported adjusted EPS that reached 63 cents. That's higher than analyst estimates. Revenue was also $38.6 billion, which is also higher than estimates. So this is really welcome news for investors because Walgreens, after all, is the second largest U.S. pharmacy chain, and its value has really just decreased the past decade.
What's the story with Blackstone? We were talking yesterday about how deals are dead. But not all deals, right?
Not all deals. We see Blackstone edging higher by around 4%. Citizens upgraded the private equity firm to market outperform from market perform, along with its peers Ares and Evercore. So Citizens analyst Devin Ryan says that these three stocks look more compelling relative to their long-term earnings power, and that's following the recent massive sell-off. He adds that uncertainty is, quote, poison for financial services businesses. And of course, Ares is up around 4%, Evercore up around 6%.
I thought you were going to say Blackstone Blackstone is up because it's selling its a healthcare business to Bain Capital.
It could be
according
because
to
of
the
that
FT.
too.
According to the FT.
We do have that crossing the wires too, but we also have this one.
The up.
Multiple things can move a stock.
We'll keep an eye on this. I do want to mention Janus Henderson really quickly. Shares up about 7%. It's kind of a deal. They're partnering with Guardian. They're going to become Guardian's investment-grade public fixed income asset manager for a $45 billion portfolio. So you can see Janus popping quite a bit on the heels of that news. But let's talk about jeans, because Levi's has had a really interesting move today. It was up 16% after earnings, but clearly that's come in a bit, Isabel.
But it's still up by 1%. This is really massive and notable because the firm maintained its full-year outlook, and they excluded the impact from the sweeping U.S. tariffs. And this is notable because usually companies have said that tariffs will affect the cost of clothing, but we have Levi's saying that it assumes no significant worsening.
But they're just ignoring it?
For now, and they also said that tariffs
They're like,
will
we're
have,
putting our heads in the sand for now.
There is a reason. They said tariffs will have, quote, a minimal impact because most of their spring and summer collection are already in the U.S. So there is that. So when you shop, know that they've been sitting in the bodega or whatever room they store that in. But we have the CFO, though, saying that it's difficult to forecast this, and which is why you see, I think, JP Morgan raised Levi's to overweight, but we have Stifel and Telsley downgrading the stock. So mixed reactions,
guys. Anyways, Isabel, thank you so very much. That is Isabel Lee of Bloomberg News. Now, coming up, the U.S. and China are not flinching as tariff tensions escalate. We're going to bring you analysis from Leland Miller of the China Beige Book International next. This is Bloomberg Open Interest. Now, President Trump said prospects for a trade deal with South Korea were looking good after a phone conversation today with acting South Korean President Han Duck-soo. But the president was less optimistic about a negotiation with China, though he did say the nation badly wanted to make a deal. Of course, we're going to want to hear from China as well. And for more, let's bring in Bloomberg's Brendan Murray, who leads our global trade coverage. When you think about the net effects of what we're seeing right now, you're seeing the administration rushing to put points on the board with every single partner that they consider an ally. But does it amount to enough to de-escalate this trade war when really the giant in the room is China?
Yeah, so far we've heard them say that they're going to enter talks with Japan, with South Korea, as you mentioned, also with India. But as you suggested, the situation with China, the relationship sounds like it's worsening. The two sides are growing farther apart in their desire to get together and start talks. The president did say that he thinks it will happen in a social media post today, but that's not the way the Chinese operate. They don't operate under pressure. They don't like to be, as they called, blackmailed. So the situation is going to have to cool down quite a bit before China is willing to come to the negotiating table. In the meantime, we're looking at, it's a matter of hours now before Trump's reciprocal tariffs take effect. That's going to add 34% of a tariff on top of the 20% that's already there. Plus, the president has threatened an extra 50%. So theoretically, by the end of today, the tariffs on Chinese imports into the U.S. could be above 100%.
Brendan, thanks very much. Bloomberg's Brendan Murray is in charge of our tariff and trade war coverage out of London. Let's stay on this game of chicken between the world's two richest economies. We're joined now by Leland Miller, CEO of China Beige Book International. Leland, how do you see this playing out? Does China have the cards, as the Trump administration would probably put it, to continue?
Well, it depends when you're talking about cards. If you're talking about a deal, you need two sides to tango. So, if Trump wants a deal with China ultimately, then they're going to have to come to the table and they're going to have to get something in return for coming to the table. If you're talking about whether the economy can withstand an extended tariff barrage, that's a different story. So, I think that so much is going on right now. It's not just about U.S.-China, that I think that both sides are looking at the other and saying, is our leverage weakening, or is it improving by what's going on right now? And I think that's going to affect, the trajectory of whether there's a negotiation in the short term.
Leland, I want to get your thoughts on what is actually playing out right now, because there is the narrative that still exists out there that Trump is using these tariffs as a negotiation tactic. You had the Secretary of the Treasury suggest as much, perhaps earlier today on CNBC, calling tariffs a melting ice cube. But then you have the other camp saying that no, Trump is very serious about these tariffs. These aren't bargaining chips. I wonder where you fall.
Well, it's not easy to pick out what the theme that the Trump administration wants when they send out two different camps saying totally different things. But I think when you look at the tariffs, they were clearly created with an outcome in mind. The levels are relatively arbitrary. They're much higher than most people expected because there's a shock and awe effect. That also lets you cut tariffs in the short and medium term considerably, and yet still keep them high, which will make everybody in the White House relatively happy. So look, there's nothing about the tariff regime that's been laid out that can't change, that can't be brought down, that can't be subject to a bunch of negotiations. You could see some tariffs go up if there's retaliation. You could see a lot of other ones go down. I think that we're not going to see the tariff levels stay at this into the next couple of months, maybe shorter than that. But I think there's going to be a lot of movement on the tariff levels going forward.
Now, I want to bring up here what's happening on a country-by-country level here, because I'm wondering if this is just a brute force question or a game of game theory. Because if you look at, I added up Japan, South Korea, India, and Vietnam, the combined total imports from those countries are $461 billion, which is more than China. Now, the composition of those imports are different. Of course, there's a huge reliance on China for certain industries, like you see with Apple. Is there something to be said here about the way the Trump administration is approaching broader Asia in relation to China?
I think there's two issues with Asia when you look at the broader Asia picture. The first is that a lot of them run trade surpluses to the United States, and that bothers this administration. The second is a lot of them are transshipment points for Chinese goods or destinations for Chinese factories that have been trying to get around tariffs. So when you're looking at the issue, they're going to have to come to terms with the fact that not only are tariffs high there, and trade surplus is quite high in most of the countries, but also that China uses them as a way of getting around tariffs that we put on China. So you're going to have to settle the Asia question, but you're going to have to do it with China. It's part of it. Otherwise, you're going to have a bigger problem. One of the reasons we saw Vietnam's trade surplus skyrocket over the last several years, because we put tariffs on China, and so Chinese capital and Chinese factories and Chinese shipments went to Vietnam to circle around those tariffs. So you're going to have a comprehensive tariff strategy for Asia that includes China. You can't just target these things one by one bilateral and expect the numbers to change.
What are the levers that China has to pull to make this painful for President Trump? Not that I'm hoping they do that, but I've noticed they're extending loans to stabilize their market. They're imploring that their domestic producers don't move supply chains. What are the things they can do? Because I don't feel like putting tariffs on U.S. imports is going to really be a problem for us.
No, that's right. Look, from a domestic standpoint, it's a non-commercial financial system, so they could buttress the economy any way they want in order to withstand the barrage. They could, of course, increase fiscal spending. I know a lot of people have been predicting that for a long time. We're actually seeing evidence of that starting in China based on China Beige Book data. But I think it's about what China's going to do to bolster its economy domestically, but also what it's going to threaten or signal that it can do back to the United States. And the question there is how nuclear it wants to get. If you're simply talking about reciprocity on tariffs, you're not going to do much because the United States imports way more than China imports of U.S. goods. So you're going to have to start talking about critical minerals even more than you are now. You're going to have to start talking about supply chains and with withholding certain goods. You're going to have to talk about punishing U.S. companies on the mainland, which I know a lot of people don't want to see. So there are ways that they can escalate quite dramatically. And then, of course, there's currency policy, which is sort of a break the glass threat. Only in an emergency do they want to pull that lever. But there are some things they can do. But again, these would be significant escalations. I think Beijing would prefer to stay away from those as long as it thinks it can still get back to the table with the Trump administration.
Well, just on the point you made about the currency, the offshore yuan fell to its weakest level on record just a few minutes ago. So you're clearly seeing the FX markets really absorb and react to a lot of these different dynamics. But Leland, I do want to look out into the future and talk about the long-term macroeconomic impact here, because you write in the notes you sent over to our producers that even if we do see these tariffs come off in 12 to 25 months, we're not going back to the environment that we had in 2024.
Well, that's right. If they stay on 12 plus months, then you're not going to go back to the environment you saw before, which is why I don't think they're going to stay on for 12 months. I think that there's going to be, right now, the tariffs are very high. They can come down and still stay very high. I think the Trump administration has to come to sort of a collective decision, with Trump obviously making the ultimate decision on where they want rates to settle, how they want to do the negotiating process. There's a lot of countries that want to come to the table, and how do they get things so that they can establish some level of certainty. Regardless of whether tariffs are high or low, you need that certainty so that supply chains can adjust, so that trade flows can adjust. Until you get the certainty, you're not going to get the results you want, even if this is the best, most well-crafted policy in the history of tariff policy.
All right, Leland, great to talk to you. That is Leland Miller. He is the CEO of China Beige Book International. Meanwhile, a quick check on these markets right now. The S&P 500, it's not quite at session highs, but it's up by more than 3%. So a really robust rebound from what we've seen over the past few days. We'll discuss next. This is Open Interest. Welcome back to Open Interest. A check on these markets right now. The S&P 500 higher by 3% right now. It's big tech that's leading the rebound, but let's take a look at the sector level because everything is green today. Of course, you do have tech out in charge, but if you pull up the sectors, you have all 11 in the green. You can see that financials also catching a bid ahead of Friday, Shonali, when the big banks report, but if you go down the list, you can see that this is a really robust rebound. We're seeing a lot of breadth right now, but there are those skeptics out there that warn this could be a dead cat bounce.
You know, dead cat bounce. We'll see where things go. I would point out that the VIX is still very elevated. It's still just under 40 at around 38, which means that even though we're seeing this bounce, that's a little fear still under the surface here. The banks like that volatility for now. At what point does it get too stifling?
It's amazing, though, how much this dead cat is bouncing, right? Because it's the fastest gain we've seen in one session since 2022, and 2023 and 2024 were really good years.
Yeah, but 2022 down 19% on the S&P 500. We'll see if we get a repeat.
Coming up tomorrow, Gabriela Santos joins us from JP Morgan, as well as Cole Smead from Smead Capital Management. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
live from New York and San Francisco. This is Bloomberg Technology. We continue to cover the aftermath of President Donald Trump's sweeping tariffs, with stocks rebounding on hopes of trade deals following the biggest rout in 5 years. I focus in on a NASDAQ 100 that is up 3.5%. Only 3 stocks are generally in the red on the entirety of the benchmark, as there are hopes on South Korea deals, Japanese deals. Ed, what's on the micro perspective?
Yeah, 2 of the biggest technology names that are in the headlines, and that's Tesla and Micron. Tesla is based around a feud between Elon Musk and Peter Navarro. Navarro commenting on television that Tesla is not a car manufacturer, it's a car assembler, which prompted Elon Musk to call him a moron, quote, and explain that actually most of Tesla's components in the car itself are built with items originating from the US. The stock at session highs, whether that's direct, who knows. Micron, Reuters reporting that Micron's passing on the cost of tariffs to customers in its supply base. The market cheered that. No comment or official word from Micron yet. They haven't answered my call, but interesting in the market's context.
From a micro perspective to the macro more broadly, Ed, trade headlines. Look, they're continuing to drive the markets, of course, with optimism building for trade deals with South Korea, with Japan, but China not backing down on President Trump's tariff threats, vowing to, quote, fight to the end. Let's break it all down. Bloomberg's Mike Shepard is with us. Very different tactics. Talk through the latest in terms of South Korea.
Well, with South Korea, they seem to be following in the steps of Japan and trying to open up very quickly negotiations with Washington on some kind of deal that would ameliorate or eliminate altogether the reciprocal tariffs that are about to take effect at midnight tonight. And those tariffs, of course, would be damaging to economies around the world, and especially to the trade relationships between these 2 tech centers, Japan and South Korea, that are so important as well to Silicon Valley. Now, the mood music is leading some to think, what would happen with China? Is China ready to also somehow approach President Donald Trump? And the president indicated in his Truth Social post that he was waiting for a call from Beijing. But the mood music, as you indicated, is a little bit different in China. They're sending mixed signals. On the one hand, they are pointing to a willingness to talk, to actually have this conversation about trade. But at the same time, they say that they are willing to fight to the end. And this is in response to President Donald Trump's threat to impose even more tariffs on China if Beijing follows through with its pledge to keep its retaliatory tariffs in place.
Mike, I'm trying to keep this deeply focused on the technology sector, right? And it's hard to piece it together. Why are the Korea headlines important? One reason, Korea sends $10 billion worth of chips to the US every year, 80% of them memory. You saw the Micron headlines from Reuters. That's one part. The other is that China's not moving, right? And that was the speculation of the last 24 hours. How do they react? What happened overnight was really, really severe. Just recap the wording that the Chinese issued.
Well, when we think about the Chinese, they were talking about how they would fight to the end, and that really sent a signal to the markets and to investors and even to companies that we could be in this for the long haul. And if you're Apple, with so much production, for example, 80% of iPhones are still made in China. Even as Apple has tried to diversify its production lines, it has been much tougher. So the signs of a thaw, perhaps, with Seoul and with Tokyo do lend some optimism, especially for producers of products. You think of Sony, you think of SK Hynix, you think of Tokyo Electron and some of the more sophisticated chip-making equipment that they produce. All of these things are in play. But China is really the big target here, just because of the size of the economy and the amount of trade that the U.S. does with China.
Bloomberg's Mike Shepard. It's Apple exactly where we want to go next. Shares of Apple rebounding in the session after what was basically biggest three-day drop since the 2000s. President Trump's tariff threats are sending customers to the stores. There's panic buying of iPhones ahead of speculated but potential price increases. Joining us, Bloomberg Intelligence's Anurag Rana. Your job is to take data, your own data, third-party data, look at the case, best and worst case scenario. What do you do with data or reporting that there's panic buying of iPhones, particularly in this country?
Yeah, but the thing is that may help, let's say minor earnings in this upcoming quarter, but it doesn't take away the big risk Apple has on procuring more phones for down the road when the next iPhone cycle comes in, when the December quarter comes in. I mean, there is a lot at stake right now, especially when it comes to the size of the tariffs that may hit China.
That's so important that ultimately May 1st, when we get their fiscal second quarter earnings, unlikely to show this. It's not going to show up until their fiscal third quarter. And meanwhile, they try to navigate not current inventory, but future supply side, maybe coming more from India. Where is that going to help them on the margin front? How much can they rely on that, Anurag?
See, they can bring some phones from India, but there are a large portion of the Pro models. India is getting hit with tariffs also. We don't know if somebody finds out that they are circumventing and trying to get phones from India. We won't have an additional tariffs on that. So there is there's a lot going on right now, and almost on a daily basis we hear about some new tariffs being slapped at. But we can remember at the end of the day, it's been the whole target of that is to try to open more factories in the U.S. unless there is some negotiation between the two countries. So I don't think Apple escapes this anytime in the near term.
Anurag Rana, putting it plainly, we thank you from Bloomberg Intelligence. For more on tech markets, we broaden it out from just Apple to across the board. Dip buyers emerging. Jay Jacobs is with us, BlackRock US head of thematic and active ETFs. Boy, have we seen some inflows and outflows, Jay. Break it down what today looks like versus the last couple of trading days.
Well, we're seeing a bit of a relief rally here and very strong volumes in corners of the market where I think people have been looking for buying opportunities. If you look at areas like artificial intelligence, look at areas like small caps, a lot of investors have been hunting for deals in these areas. And now that they're off, 10, 15, 20%, it represents a really attractive entry point for long-term investors. So we're seeing people get very granular about finding targeted opportunities for these lower valuations here.
And they therefore think that the valuation erosion that we've seen in some of these AI names, some of the chip stocks in particular, that they're at the right buying price right now, Jay?
Well, there's certainly at contracted valuations here. And what we've been hearing from clients for a while is, they love the AI story. They see the structural disruption. They see the massive total addressable market of artificial intelligence. It was really just a question of valuations. Was this an area that was a little too hyped, a little too inflated by the markets? Now that you're seeing those prices basically 20% off since the beginning of the year, those concerns are gone. And yes, maybe the landscape looks a little bit different, but if you still zoom out and look 10 years ahead, there's a ton of conviction in artificial intelligence, and at these valuations, it's hard to pass over.
Jay, if the trade conflict goes on indefinitely, is there a corner, a specific area of the technology industry where you do want to boost your exposure?
There is. We actually brought out a strategy a couple of years ago very focused on this, which is IETCs, our U.S. tech-focused ETF, and it's specifically looking to remove geopolitics from technology stocks. The tech sector has over 60% of its revenue coming from overseas, very globally integrated supply chains, and if you can really isolate companies that hire, build, and sell in the United States, you can still get that tech exposure, that tech growth, but try to limit
what's in it?
And limit some of the impact of supply chains.
Jay, what's in it? What names are we talking about? What specific technologies, specific supply chains do you want to go into?
Well, if you look at the portfolio today, it's actually underweighting several of the Mag 7 stocks that make up such a top-heavy amount of the tech sector as well as the communication sector. A lot of those stocks are still very globally integrated, have a lot of sales overseas. It's looking more domestically, sometimes at e-commerce companies that do a lot of buying and selling within the United States, some AI-related companies that are doing a lot of buying and selling in the United States. But it's really kind of reweighting the tech sector, and that top 10 looks very different in a fund like IETC than just kind of the broad tech sector.
Jay, how are you currently discussing with those that are allocating towards your funds the long-term versus short-term? How many are wanting to commit at this moment if they are worried about what the next headline seems to be bringing?
It's really about getting granular and taking that long-term view. We have seen a lot of investors, again, are really kind of looking for what's the targeted exposure that they have the highest conviction in over the next 5 to 10 years. And look, you get compensated for taking equity risk, and we're seeing equity risk play out in the markets today. So if you can take that long-term view, get granular on the themes like artificial intelligence that people believe in over the long term, we believe they should be rewarded over time. So in many ways, it's opportunity hunting, but it's also behavior and behavioral coaching around being invested and staying invested during turbulent times.
It's important to remind oneself that all of the things we've been spending the last 2 years talking about haven't ended or gone away. The AI infrastructure build out, all of the forecasts are multi-year. I guess for you, when you think about construction and you think about clients, it's your conviction on whether the trajectory we were on in 2024, particularly around AI infrastructure data center, continues. Do you feel that way?
I don't think there's a major shift here. Tech companies are very good at planning for the long term around these very, very, capital intensive build outs. And so if you're building a data center today, it's because you believe in AI 3 to 5 years from now. And I think what's different about this time around is you have tech companies that are flush with cash, that continue to bring in new cash through free cash flow. And they see a huge potential market in artificial intelligence. So they're excited to invest in this space. They're excited to put their capital work, and they're planning for the future.
You said the word cash 3 times there. Interesting. Data center, memory chips. You guys interested in that market?
We are. So we look at the entire AI technology stack for opportunities. And, you could kind of look at the bottom of that tech stack, starting with what is the real estate that is really hosting the digital infrastructure required for artificial intelligence. On top of that are a lot of the semiconductor companies, not just GPUs, but memory, transceivers. We really like that digital infrastructure area right now because that's where a lot of revenue is being channeled in artificial intelligence for the next couple of years as we see a build out of AI.
Right. Jay Jacobs of BlackRock, really great to have you back on the program. Thank you very much. Now, coming up, former U.S. Treasury Secretary Larry Summers joins us to talk tariffs and why he expects more turbulence. A key conversation coming up here. This is Bloomberg Technology.
our Bloomberg audiences worldwide. I'm David Weston, and I'm joined now by the former U.S. Treasury Secretary Larry Summers of Harvard. Larry, thank you for being back with us. When we talked just a week ago on Wednesday, the day of the announcement of the tariffs, there was a lot yet to be determined. The markets have been through an amazing amount of volatility since then. 3 down days. They're sharply up today. You've been quite explicitly critical of what President Trump has announced here. Do you feel better today because the markets are coming back?
Sure. I feel better anytime instability seems to be calming. But be not confused. There's only one reason why instability is being reduced, and that is there's a growing hope in markets that a larger part of these policies are going to prove transitory and reversible. This does not reflect any kind of market endorsement of the approach that the president has followed. Rather, it reflects a judgment that the president might recognize the reality that markets are telling him about, that many of his advisors are telling him about, that corporate CEOs across the country are articulating, that this kind of wholesale tariff policy is simply bad for economic performance. We're seeing some signs that the administration may recognize that.
We're seeing signs, but do we have a better sense of the goals and the process today than we got from the Rose Garden last Wednesday?
I don't think so. I think this is fundamentally a improvisational effort. You could tell that when you knew that there was a policy based on tariff reciprocity that didn't use any data on the tariffs of other countries in figuring out how to reciprocate. You could tell that from the blatant contradictions between what Presidential Advisor Navarro was saying and Presidential Advisor Treasury Secretary Scott Bessent was saying. You could tell that from the degree of division between close outside advisor Elon Musk and many members of the president's economic team. This is a policy, it's a hugely consequential policy, but by all appearances, it's being improvised on a daily basis, and that's creating huge uncertainty. But it's only uncertain. There's only uncertainty if things go in both directions. And today happened to be a day when things moved in a positive direction. I hope that the moves to back off these policies can continue. But we'll have to see. I suspect we're going to have volatile markets for some time to come, and no one can know, but my judgment is that I'd be surprised if the bottom is yet in with respect to this phase and markets.
How bad could it get?
Oh, I think the likelihood, I think it's more likely than not that we're going to have a recession. And in the context of a recession, we'll see an extra 2 million people be unemployed. We'll see losses in household income that are $5,000 a family or more. We're very likely in the context of a recession to see markets reach levels significantly below their current levels. So I think we could be looking for fairly serious economic problems, and I think it will cast a shadow forward, because if we have a recession, the budget deficit will go up, the accumulated debt that we have to deal with will go up, there'll be financial distress that will affect higher risk companies and also higher risk countries in the global economy. But David, there's a a central thing to understand about this moment of economic and financial difficulty. To borrow a word from the doctors, it is our first iatrogenic recession, our first iatrogenic financial crisis. Iatrogenic illness is when you go into the hospital and you catch an infection there. It's when the people whose job it is to make things better are the active agents of making things worse. And iatrogenic illness, staph infections and the like in hospitals is a major preoccupation for doctors. This is an iatrogenic economic challenge. There is nothing in the outside world that is causing this challenge. It is induced by the words and deeds of President Trump and his administration. The good news about that is it could be resolved with words and deeds of President Trump. If they backed off these policy errors, I think there would be a substantial resumption of normality. But as long as a hospital maintains unsanitary conditions, its patients get infections when they enter. And as long as these policies are being pursued, we're going to see substantial volatility in markets, substantial recession risk, substantial damage to middle-class families.
So just to follow up on that, is there any remedy for the patient other than for the chief doctor, that is President Trump, to back off what you just described as policy errors? Is there anybody else who can save us?
Look, depending on what happens with other countries and how they handle their diplomacy, it may be easier or harder for him to back off these policies, depending upon how the business community responds. There may be more or less ability to create an environment where there's a backing off of these policies. But there's nothing complicated about this. You impose huge tax increases on households in an uncertainty-creating way that's also damaging to established business patterns, and the economy turns downwards. There's nothing subtle or sophisticated about this. This is introductory economics. It's the kind of question that could have been on an introductory economics exam for decades. Suppose the President of the United States decides suddenly to impose a massive tariff tax increase on products from all over the world. What will happen to the economy? And any B student will know that the answer to that is that it's a supply shock that raises prices and raises unemployment as well, and makes the economy less efficient and adds substantially to uncertainty. This isn't some sophisticated, complicated thing to analyze.
Larry, thank you so much for being back with us. Really appreciate it. That is former U.S. Treasury Secretary Larry Summers of Harvard. Back to you.
We thank you, David Weston. We check back in on these markets on the heels of that interview. The Nasdaq coming off of its highs. We're now just up 2.7%, but still the best day since August 2024, after what we'd seen as a couple of days sell-off prior to yesterday, which is the worst in 5 years. We go into the biggest movers from a points perspective. We're thinking about consumers booking high. Mercado Libre, Latin America exposure, Netflix up 3.4%. Coming up, Samsung quarterly profit beat expectations. This as President Trump signals there may be a trade deal with South Korea. We'll get to that next. This is Bloomberg Technology.
Technology shares literally just touching session lows in the last couple of seconds. NASDAQ 100 up now, 2.5%. But we're also seeing some current downward pressure. Bitcoin's been around 78,000 US dollars per token over the last 3-4 days. Remember, it traded over the weekend. There is more buoyancy. We are rebounding, but there are many, many more tariff and trade-related headlines to digest. Don't go anywhere, because we'll be right back. This is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Some markets, Karen.
Yeah, let's check in on them because we're coming off of our highs. The Nasdaq 100, though, still clinging to 2.5 percentage point gain. We're seeing very few stocks in the red today as people start to buy this dip and hope that more trade deals might come. South Korea, Japan in the mix. Move on and have a look at some individual chip stocks that I want to shine a light on because deals are actually getting done. Marvell selling its auto-related part of the business to Infineon, the German company. We're up 6.8% on a $2.5 billion deal. Broadcom buying back its shares. Steep discount after the recent sell-off, 6.7% higher as they say they're going to be purchasing some $10 billion. And Micron, interestingly, reports coming that it is looking to pass on some of those tariff costs to customers. It's up 2.5%. But let's dwell on another chip company. It also makes phones and plenty of other things. Samsung shares climbed over in London trading after South Korean tech giant reported better than expected preliminary results for the fiscal first quarter. It also comes, of course, as President Trump said the prospects for a trade deal with Seoul were looking good. Let's dig into it. Peter Elstrom is here with us, still in New York. Let's go to the earnings first. The fundamentals looking good for memory in particular.
Yeah, that's right. So Samsung reports its preliminary earnings right after the quarter closes. We'll get more detail later on, but at least the preliminary numbers were very good. Revenue was up 10%. Their operating profit was $4.4 billion, well ahead of what analysts had anticipated. There are a couple things playing into the results here. First of all, DRAM, the legacy DRAM business is taking off quite a bit, and they have a new Galaxy smartphone out there that's doing quite well at this point. So Samsung, at least at this point, is showing some progress. We know that they are well behind in terms of AI memory chips. They're trying to play catch up with SK Hynix. They didn't give any detail on that today, but we may get it later on in the month.
The memory market's very interesting in how Samsung plays it, right, particularly when it relates to China, because they are catching up, but they are able to currently serve customers in China until the US tightens export restrictions. Just go with that with us, Peter.
Right. Well, the U.S. administrations, first the Biden administration, now the Trump administration, has been quite concerned about some of these chips that are going into China, being sold into China. NVIDIA chips, of course, is sort of the top of the list there, but also the high-end memory chips are a concern for them. So SK Hynix makes the high bandwidth memory chips, the HBM chips that are going into China. They have been affected by this. Samsung could also get affected by this in the future. And the goal of the administration is try to cut off some of these AI capabilities that China is trying to build. In the meantime, of course, those domestic players are competing and they're trying to gain some ground back. China, Samsung in particular, has been struggling because they do have customers in China they want to be able to sell to. But most importantly for them, they want to get verified by NVIDIA so that they can sell the HBM chips that NVIDIA needs for their AI capabilities.
Bloomberg's Peter Elstrom, thank you very much. Let's get more on how technology investors are reacting to all of the market turbulence. Beth Kindig, lead tech analyst at IO Fund, joins us now. And Beth, really grateful to have you on the show. I enjoy the kind of breadth of your commentary on X, actually. Some of it tariff and markets focused, a lot of it actually the underlying technology. But given the markets that we find ourselves in right now, what's your latest thinking on the technology sector and how you're going to play the uncertainty of a trade war?
Yeah, look, nobody holding stocks right now is comfortable, especially tech investors. Tech will overweight impact from tariffs, whether it's the electronics, the data center equipment. We're talking hundreds of billions in imports every year that could be impacted. Ultimately, though, the market can top on good news and it can bottom on bad news, meaning we're seeing SMH semiconductor ETF up 5%, despite the threat of up to 100% or higher tariffs in China. Not confirmed, but you've seen some activity over the weekend in that regard. What that means is we are positioned for a bounce. We think that we're in extreme oversold conditions. If you look at the sentiment reading, retail has almost never been so bearish. It's more retail is more bearish than COVID and more bearish than 2009. What that means is the market is oversold. We are positioned for a bounce, and that bounce may or may not continue onward, meaning we still remain cautious even with positioning for a bounce.
So forgive me, Beth, have we or have we not hit the bottom in tech?
It is not likely we've hit the bottom through all of the damage that was done last week and the damage that we could see this year.
So Beth, we turn to you when IO Fund has outperformed most benchmarks for the last couple of years, and indeed a lot of the other tech-focused funds. Do you make the most of these valuations, just go very focused on individual names and just withstand the volatility, or do you wait for a better outcome? Do you wait for more clarity from President?
It's a little bit of both. We layered in on Friday and Monday. The reason is it's clear to us probability favors that bounce. That bounce is very important for a tech investor because of the damage that was done. You have to capture that bounce if you're going to compete on an annual basis like my firm. And therefore, capturing that bounce is key. De-risking on a bounce rather than during capitulation is everything to a tech investor. Being very strategic. So de-risking on that bounce is key to the performance this year.
It's interesting, Scott Bessent, of course, Treasury Secretary, has time and time again said this isn't a MAGA problem, this is a Mag 7 problem. The NASDAQ peaked back in February. This is actually about DeepSeek. And to that point, we've seen pressure on chip stocks running into this tariff crisis. We were worried about an AI infrastructure bubble. How much have you been paying credence to that, or was the market getting that wrong too?
It is a Mag 7 problem. We hold very few Mag 7 stocks because of the outsized spending on CapEx. You have to think about, is the schedule for depreciation on servers, is that even accurate? Is it really going to be a 5 to 6 year depreciation schedule? That matters, because if it's not, and it's more brief due to these Blackwell systems coming out, and then Blackwell Ultra, and then Rubin, we can see more effects on the bottom line, meaning they're the customers. That is not typically the way the Mag 7 was constructed. And that piece is important to understand. There's a shift in how big tech was the producer, but now it's the customer.
I saw you say on X the other day that AI needs compute, and when it comes to compute, NVIDIA is the gold standard. So if you don't hold many Mag 7 names, do you hold NVIDIA? How do you see NVIDIA's ability to continue its trajectory in this environment?
NVIDIA is the exception. NVIDIA is the beneficiary from all of this CapEx. Very low China exposure. There's a semiconductor exemption to the tariffs. Of course, there would still be some impact, but by far the safest stock in the market today is NVIDIA.
Currently trading more than 5% higher. Beth Kindig, great to have you on the show, lead tech analyst at the IO Fund. We thank you. Coming up, we're going to speak with Dan Ives of Wedbush Securities. You've heard him cutting the price targets of Tesla and Apple. More on that next. This is Bloomberg Technology. We have some breaking news for you at the moment, and this time it's not on tariffs, but we understand that hackers have indeed been spying on 100 bank regulators' emails for over a year. Ed, we're going to be delving into the details. I know you've got the story in front of you at the moment, but hackers spying on 100 bank regulators' emails for over a year, just showing the extent to which technology has been lapsing for key overseers here.
Yeah, the Bloomberg report that cites sources basically says that the hackers had access to the deliberations of regulators who are deliberating information about the banks they oversee. Clearly, it's a deep report, 150,000 emails from June 2023 until they were discovered earlier this year. We'll get with the team that broke that story. It seems like a big one that's certain to have repercussions from Bloomberg Tech Newsroom. There's a lot more happening in the world as well. Elon Musk took to X to criticize President Trump's top trade advisor, Pete Navarro, calling him, quote, a moron. This was in response to Navarro's comment that Musk is a car assembler rather than a car manufacturer. That also comes after Elon Musk's younger brother, Kimball Musk, criticized President Trump's tariff strategy, calling them a, quote, structural permanent tax on the American consumer. Bloomberg's Kara Carlson is in Austin, Texas, and has the fortunate job of untangling all of that. I think we should start with the feud between Navarro and Musk. And actually, if you look at the data, third party or Tesla's own, there is support for what Elon Musk is saying, that vehicles built in the United States, source components from the United States, are assembled and manufactured in the United States, sort of nose to tail.
Yeah, definitely. You know, this is something that Tesla's been promoting for a while. They